It's October. That means it's time for Halloween decorations and some scary times in the market. Yeah, the first thing is correct, and some volatility in the market might not be here yet. I'm Tom Preston, Chief Market Strategist at tastylive, and in this week's Cherry Picks, we're going to take a look at implied volatility across some asset classes and how that impacts option prices. But first, just for the sake of argument, let's take a look at some Halloween decorations. The stuff these days is just off the charts. My kids are old. They don't love this stuff. You know, it doesn't entertain them. And where I live, we don't get that much Halloween traffic that anybody would appreciate it. But look at this. Animated LED night, $379. Levitating Reaper, $299, Home Depot. Soul Sucker, $299. Look, giant-sized Inferno Deadwood Skeleton, $370. As a kid, I would have loved this stuff. I had to content myself with, you know, last year's bed sheets that my mother let me turn into a ghost. Let's go back into Cherry Picks now and see how the market treats volatility. So implied volatility is a measure of uncertainty in the marketplace. What actually is it? Implied volatility is derived off of option prices, and it is forward looking. Implied volatility is when you take an option price and you determine what volatility that when you put it into a theoretical pricing model like Black-Scholes, for example, makes the theoretical value equal to the market value of the option. That's what it is. Whatever volatility makes the theoretical price equal to the market price, that's the implied volatility of the option. When implied volatility is high, when there's a lot of uncertainty, all option prices go up in value. When volatility is low, less uncertainty in the market, option values come down. That's why when we look for short premium strategies, you know, when we want to sell options, we tend to look for products, stocks, ETFs that have higher implied volatilities. Why? Yes, there's more uncertainty. Yes, there is more risk. Yes, they could be scarier. Hey, it's Halloween. But that's where we're being rewarded for taking that risk and accepting the uncertainty and maybe living through a little scary times. Let's go take a look at something, Bitcoin and volatility. Now, Bitcoin, if there's one thing a lot of people are afraid of, is crypto. Let's just take a look at a chart of Bitcoin right now. Bitcoin hasn't gone anywhere. Yes, it has a lot of swings up and down, but for a $60,000 product, it really hasn't moved very much. And that sort of, you know, belies the idea that, you know, Bitcoin and crypto in general are these super volatile things that aren't suitable for a lot of people. So look at this chart the guys put out. So this red line, the black line is Bitcoin, and the chart we just looked at is basically this period right in here where Bitcoin has really been stuck in a range. This red line is the implied volatility of Bitcoin options. Okay, so what we've seen is it was very high back in the spring of 2022, and then it started to drop, and it's been relatively low. Now, Bitcoin volatility compared to the market volatility, that is the VIX, for example, is really high. But that just goes to show you that when things aren't happening in the market, typically volatility starts to decrease. Let's look at some of the individual products, the ETFs that are the most volatile. One of the things is small cap stocks tend to be more volatile than big cap stocks. These little companies that are maybe worth only $1 billion are more volatile than something, you know, like Apple. So what we have is the small cap stocks in the Russell 2000, the IWM, tends to be more volatile than the Qs, SPYs, and DIA. This is kind of a busy chart, but these lines are the implied volatilities of these four indices. The blue line is the Russell, IWM. The orange line is Qs, green line is the SPY, and the red line is the diamonds, the DIA, the Dow 30. Pretty typical, okay? So the smaller cap stocks concentrated in the IWM generate a higher implied volatility. The Qs, a lot of overlap with the S&Ps, but the S&P 500 has more stocks to diminish its volatility. So the Qs have a higher implied volatility than the SPY, and the Dow Jones, which is the Dow, kind of the big 30 sleepy stocks of American industry, has the lowest implied volatility. So let's look at some skew. And skew is, once you calculate, let me stop for a second. What is skew? Well, remember when we took the implied volatility of the option? Well, if you pick one option, you get one implied volatility. If you look at another option in the same stock, same expiration, but a different strike price, you get a different implied volatility. Let's actually take a look at that just for the sake of argument. Let's go into SPY, because it's easy. So if we go out to the Nova expiration and I switch over, here's the implied volatility listed along with each strike. So what I'm talking about with the skew, SPY right now is trading at 579.51. It's right in between 579 and 580. So this is the at the money. The at the money is trading for about, let's just look at puts. The at the money volatility is 14.24%. As we go down to, let's say, the 570 strike, it's 16%. As we go down even further to the 560, it is 17.89%. The fact that implied volatilities are different across the strikes for the same ETF or stock, that is volatility skew. So that's what we're talking about here. So as we go into some of these individual products, so looking at the skew for Tesla, has a much greater call skew, 20 points out of the money. The calls are 50% more expensive. Well, let's take a look at that. If we look at Tesla, earnings are coming up next week or in a couple of weeks. If we go out to, let's say, Nova expiration, so stocks trading at 219. Let's say this is really rough stuff. Okay, 220. This is how you have to think as a trader. In other words, you don't get too caught up in, well, it's only, it's closer to 219, but there's no 219 strike. What do I do? Just go with 220. Okay, 220, 10 points down, and the put is trading at 740, 10 points up, the 230. The 230 calls are trading at 1170. The 200 puts are trading at 740, and these 230 calls, or excuse me, I was looking at the 200, I need to go to the 240s. The 200s are trading at 740, the 240s are trading at 850. The fact that the calls, the equidistant calls are higher means there is, market sees risk to the upside. It doesn't mean that Tesla's going higher. It's not what it means. It means that the market sees risk to the upside. Right now it's about $1 higher, which is about, 15% or so, a little less than 15% of that. Different snapshot of data. But the skew is definitely pointed to the upside in Tesla. Let's take a look at the next one. Bonds, and they're looking at TLT. TLT is the ETF that tracks the let's say, long-term bonds, so 20 to 30-year Treasury bonds, TLT. Let's open up 35 days, and stocks trading at 94, let's say, so 94, go down 2 points to 129, up 2 points to 96. Yeah, 129 versus 125, that's pretty much the same. So in this case, the implied volatility isn't telling us about risk one way or the other. It says there's roughly equal risk to the upside downside. And the third one the guys pulled up is NVIDIA, has slightly greater call skew. Let's pull up NVIDIA. And these are obviously different products. You've got Tesla, TLT, and NVIDIA, different products, different stocks, and different implied volatility scenarios. So NVIDIA also, earnings coming out in a little while. Let's go out to 49 days and we'll see where it's at. So about 134.79. So kind of right in between. So let's go down 4 points from 134 down to 130 and up 4 points from 135 to 139. So right now I see again 890. And because it's biased towards 77, it's biased towards the 135. So the skew isn't that steep, but it's pointed a little bit towards the upside. Okay, let's look at a couple of trades that the guys pulled out to take a look at. One was a GLD broken wing butterfly. Gold has rallied to all-time highs. That's true, and took a little bit of a sell-off. So they're going out to, this is 38 days, a few days ago in the Nova expirations. They're buying the 245, selling the 250 call, and selling the 260 call. Let's take a look at that really quickly in GLD. And GLD, just like you said, has been rallying. Let's go out to the Nova expiration. They're buying the 250, selling two of these 55s, 45, 50, 60. 45, 50, selling two of these, and then a 60. Okay, and they're doing that for a 16-cent credit. Yeah, you know, it's not a bad trade. It requires about $484 of capital, so not too high. A smallish account, let's say a $5,000 account, could do this. Max loss is $484. Max profits $516, generates about $2.13 of theta, and 68% probability of making half its max profit. Remember, with these unbroken butterflies, broken wing butterflies, there's an embedded short vertical. If you went equidistant up here, 245 to 250 is 5 points. So 5 points beyond 250, if you're going to do the regular butterfly, just the straight butterfly, this is just a plain butterfly. Okay, 245, 250, 255, 5-point butterfly, you pay a debit for it. What the broken wing butterfly does is add a short call vertical to the butterfly. You're selling the 55, 60, you're selling the 55 call, buying the 60. The net effect is that it cancels out the 250 call and gets you along the 260 call. That's what generates the credit. If you wanted less risk in this, you could tighten these strikes up a little bit to let's say the 248, 250, and then bring this down to, this is the regular butterfly, and yeah, I could do the 253 or 254. It's a smaller requirement, you know, 157, 150 buying power requirement, 155 max loss, 55 cents of theta. So that would be for, you know, maybe a $2,000 account. Maybe, okay. Let's take a look at, and this is a trade if you think gold will rally a little bit, but not too much. Let's go take a look at the next one. It's heavily weighted toward NVIDIA. So they do another one with 260, 270, 290. Again, take a look at this. 60 to 70 is 10 points, 70 to 90 is 20 points. That is what makes it a broken wing. And by the way, the reason you're checking out these short call verticals is GLD, 70% IV rank makes it really attractive for short premium. SMH, 48% IV rank, and you know, 38, 39% volatility, pretty steep. So let's open up this. They were looking at the 60, 70, 90. 60, 70, 90, buying this one, selling two of these, and buying a 90. Take a look at this. $971 of buying power requirement. Max profit. Max profit occurs if it goes right to 270. From SMH right now is trading at 256.96. It goes up 13 points at expiration. That's when you get your max profit, but that's hard to get. And the embedded short vertical here is, let's guess, it is the 280, 290. Okay, so I take the regular 10-point butterfly, 260, 270, 280. I added an 80-90 short call spread, and it turns into the broken wing for 29-cent credit. That's what it is. So if you wanted less risk in this, again, you could tighten this whole thing up, and that's basically what you do. So this 265, 270, 280, I am short a 275, 280 call spread. That's what gives it a margin requirement of about $413. Max loss is much smaller, $413. If you get a huge rally up, again, this is assuming SMH is going to rally up to 270 and not much higher. That's what this trade is about. But again, theta is 1.93. You have a 83% chance of making 50% of its max profit. So I hope you found that helpful. And how we look at implied volatility. If you want to get these cherry picks delivered to your inbox every week and my cherry bombs every week, click on the link below.